Hello, everybody, and good morning. I'm Tim Henshaw, Head of Agribusiness at Westpac, and I'm thrilled to welcome you to this Westpac Smart series. Today's session is all about exploring the red meat sector, changing population demographics, changing consumer preferences, technology, they're all having an impact on agriculture. So with me today, I have Westpac's Industry Economist, Paul Clark, Senior Economist, Darren Gibbs, and they will both be sharing their insights on production and consumption drivers in the red meat sector. And personally, I love my steak, and last weekend I was at a dinner and the main dish was a slow roasted lamb shoulder, and the whole table was in raptures about this amazing tasting dish. So I'm really keen that we get to the bottom of why our farmers aren't getting a higher price for these amazing products. Our session today is planned for 45 minutes, and we'll ensure we have 10 minutes at the end for Q&A. The Q&A will be running live on the right of your screen, so register your questions as they come to mind. If you like a question that someone has raised, click on that, and that will increase its rating, and we'll work our way through the highest rated questions first. So let's get started. We'll go down to you first, please. Darren, what are the macro drivers of red meat consumption?
Well, I guess in a structural sense, the key drivers are the number of mouths to feed, in other words, population growth in our key markets, and growth in per capita income in those markets. And also there are cyclical factors, the state of the economic cycle, consumer confidence, cost of living pressures. These also feed into decisions made by households about the type of protein that they choose to consume. Now, if we look at the slide on screen, the Food and Agricultural Organization of the United Nations, together with the OECD, have done some quite interesting work looking at how consumption of different forms of protein varies as countries get richer. The slide shows that per capita consumption of red meat has changed for various groups of countries over the past 30 years as those average incomes have grown. The unfilled circles are forecast for the next 20 years. Now, if we concentrate on the lower left of the chart, for example, the dark blue dots, what you can see there is an upward slope. In other words, per capita consumption of red meat has been rising in those lower and middle income countries as their ongoing economic development lifts their wages. And that allows them to access more expensive forms of protein that were previously outside of their budgets. Now, if we turn to the top right-hand side of the chart, those red circles show the situation in wealthy countries. And in contrast to the less wealthy countries, what we've seen over the last 30 years is that per capita consumption has actually been quite flat or even declining, even as incomes have continued to rise. That decline is especially noticeable with respect to sheep meat. Incidentally, we see the same trends here in New Zealand, where per capita consumption of beef, and especially sheep meat, has declined markedly over the past 30 years. Now, interestingly, the same research shows that flat or declining trend in red meat consumption in wealthy countries is not shared by other forms of protein. For example, per capita consumption of poultry is continuing to rise in all countries, including wealthy countries such as New Zealand. So I think this illustrates that demand for different forms of protein also depends on additional non-macroeconomic factors. For example, this includes movements in relative prices. We know that poultry has become cheaper relative to red meat, doubtless causing some substitution towards poultry and away from red meat. And obviously, changing consumer preferences are also probably at play.
Okay, thanks, Darren. So, Paul, then what are the micro drivers of red meat consumption?
Yes, good morning. So Darren has basically explained some of the macro drivers, but there are a whole range of other factors that shape individual customer preferences, and these drive decision making and they influence meat consumption. So we normally like to categorize these, and we categorize them into psychological factors, which includes attitudes and beliefs, sort of vegetarianism, for instance. There's social cultural factors, there's religious factors to be considered. There's also marketing factors. I think Darren touched briefly on the price of competing proteins, and that includes things like poultry, where we've seen really strong per capita consumption growth, and in some markets, fish. Marketing factors may also include things like branding, labeling, and convenience. Then, of course, it comes down to what does the meat look like? What is the taste? What is the appearance? What is color? And what does it smell like? I think you referred to that in your opening remarks. There are other factors. Increasingly, the science has shown that basically excessive consumption of red meat can have some health risks, or does come with some health risks of heart disease and cancer. But again, that's excessive consumption over a long period of time. Other proteins, often cheaper, do not often pose the same kind of risk profile. Then, of course, you've got production factors, and that really refers to basically animal welfare concerns. This is about treating animals humanely during the slaughter process and as they're being processed. And of course, there's traceability all the way from farm to fork. On top of that, of course, and we're all aware of this, is the environmental issues, carbon footprint, emissions, the impact on climate change, and I think more broadly environmental sustainability. Now, the importance of these sub-factors, the sub-factors that make up these factors are shown in the slide and shown in the chart being currently displayed. And you can see that this is really a survey that was undertaken in 22-23 of factors that buyers consider when, the individual factors that buyers consider when consuming meat in New Zealand. And just to give you an idea, affordability, of course, is really important. 80% of respondents said that that was a key factor, and saving money came in third on the list at 74%. Of course, health also rates quite highly, coming at second and fourth on the list. But as you can see, some of the other factors, animal welfare, environmental considerations, are also among the top 10 or so.
Great, thanks, Paul. And if we stay with you, who are the key participants in the red meat sector, either as producers or consumers?
Yeah, so we've got the charts on your screen here. Basically show those global producers. I think we show in the charts basically production, consumption, imports, and exports for both beef and sheep meat. And I suppose from beef, what really stands out is who are the key players here, and that's really the US, China, Brazil, and the EU. They dominate production and consumption. We've also got Argentina in there, is also a significant producer. Now, the US, of course, imports about 2 million tons each year, and that's kind of stable. It exports 1.5 million tons, or did so in the last year, and that can be fairly variable depending on what happens with their own beef herd. They're a constant source of demand, and that's important for New Zealand, of course, because we export into that market, and we'll be covering that a little bit later on. China, of course, is a really big importer. It's a big producer, but it's a big importer, especially of beef, and that's grown substantially over the last wee while, and we'll talk about that in a little bit more detail. Importantly, it exports very little, whereas the US does export. Other key players include the EU, but they're a big producer, a big consumer, but they do very little in the form of trade. Obviously, that excludes interregional trade between countries that are part of the EU. Brazil, of course, is a really big producer. Got a lot of land, and it's cutting down some forests as well. And that together with the US, they're the world's largest beef exporters. It's important, though, Brazil mainly exports into China, and has been diversifying away from that market because of weak consumer demand in China, and that means it's competing with other countries. I suppose the other thing I'd like to raise around beef is Argentina. Argentina is a significant producer, not a massive producer, and until relatively recently, it basically had removed itself from the export market, largely in a bid to bring down domestic prices. But now they've returned to the export market, so they're also adding to supply in export markets. Yeah, I mean, the key thing here is that New Zealand is a big exporter to the US. I mean, we export about 72% of imported beef into the US is what they term lean trimmings. Which the US manufacturers basically then take and they mix with their own beef, And a lot of that comes from New Zealand. So that's a very important market for New Zealand.
So Paul, they absolutely need us there, don't they? Because they need our lean trim to mix with their fattier grain-fed product to get to a middle ground that can go into their burger patties.
That's completely right. They love their burgers, and we produce the kind of meat that they need basically for those. I mean, we also export into other countries a higher quality meat, but certainly in that market, we are a key exporter of lean trim, and you're quite right. They do depend on us for that. So that's very positive for local farmers. I think if we flip over to the right-hand side, the right-hand side chart, all roads lead to China. It is by far the world's largest consumer and producer of sheep meat. It's also its biggest importer rather. Although those are really small when you compare that to beef in terms of tonnages. I think it imports about 0.4 million tons. That's mostly from Australia and New Zealand. After China, the biggest producers of sheep meat are the EU, Australia, and the New Zealand. And as for beef, if you look at the EU, for instance, it produces basically for its own consumption, and that's supplemented by small volumes. Again, they come out of, I think Australia dominates that market, with New Zealand coming second. The UK is a small producer and consumer, but it is important to New Zealand as a traditional market for our sheep exports. We continue to do well in that market. I suppose the only last thing I'd like to say about that is Australia is the largest exporter of sheep meat in the country. So if you look on the right-hand side of that chart, you can see that Australia's the big player there in terms of, outside of China, of course. It's the largest exporter of sheep meat, followed by New Zealand. And there's many reasons for that. One of that is that we've seen in recent years an increase in flock size, which has led to an increase in slaughter rates in Australia. And they've been able to bring more sheep meat onto the market, and take a little bit of market share away from New Zealand lamb.
Okay, thanks, Paul. We might come back to that as well, that Australian flock size. So Darren, which markets are New Zealand exporting to, and how are those markets faring?
Sure. Well, the slide on screen will show the destination of New Zealand's beef and sheep meat exports, just looking over the last 9 years. So if we start with beef, New Zealand sold around $4.5 billion worth of beef into global markets over the past year. Most recently, about 70% of that exports has been destined for the US and China combined, worth about $1.6 billion per annum in each case. But while their combined share has been quite stable, China's share has generally trended higher since it first began to import beef back in 2012. However, last year we did see China's share of New Zealand exports fall. This reflects weaker spending in general in China, but also the recovery of pork production there, and thus lower pork prices, so substitution back into pork. Also increased import demand from the US as the beef herd there fell to a multi-decade low. Now, aside from the US and China, sorry.
So Darren, that's a really important offset there, right? We had China down, US up, so that diversification, multi-market is very important to us.
Absolutely. It's definitely, the more diversified we can be, the more we can sort of handle those shocks when one market's not performing quite as we would like it to be. So the more we can do that, the better, certainly going forward. Aside from the US and China, other significant markets include New Zealand beef include Japan, Taiwan, Canada, South Korea, although it's important to remember that collectively these markets are less than half the size of either the US or the Chinese markets. Now, if we turn to the right-hand chart, sheep meat, we're selling about $3.7 billion worth of sheep meat into world markets each year. In this case, China is by a large margin our dominant export market, accounting for around $1.4 billion or 40% of export receipts in recent years. And as with beef, exports of sheep meat to China really only began in earnest in 2012, as Chinese producers were unable to keep up with rapidly growing demand. And I'm sure Paul will have a lot more to say about the dynamics of the Chinese market. Although the US is not a large consumer of sheep meat, the share of New Zealand's exports going there has been rising, which is encouraging. And it reflects the fact that US production of sheep meat has halved over the past 30 years, with imports now playing a dominant role in fulfilling consumer demand in the US for sheep meat. Aside from China and the US, the main other purchases of New Zealand sheep meat include some of the traditional markets. Exports to the UK have increased in the current season, which is encouraging. The Netherlands, Germany, Belgium, France, Canada also take more than $100 million worth of sheep meat each year from New Zealand, but again, small players relative to China. So if you look forward, how are macro conditions evolving in those major markets? Well, as I noted earlier, prospects for demand depend on a combination of population growth and also incomes. I guess in China, the economy is currently growing at a rate of about 5%. Now, that's less than in the past, but the economy is much bigger now. Unfortunately, that growth continues to be driven more by industrial activity and exports. That's the kind of growth that's more beneficial to a hard commodity exporter like Australia, rather than consumer demand, which would be more beneficial to a soft commodity exporter like New Zealand. Indeed, consumer demand remains quite weak in China. Confidence is low. They have falling asset prices, especially for housing, and that's due to well-documented problems within the Chinese property sector. Even so, for now, the Chinese middle class is continuing to grow. But it's important to note that they do have an aging population, a consequence of the earlier one-child policy. And that means that China's population is actually set to shrink over coming years. So while Chinese demand for red meat will probably continue to rise as incomes rise, it does seem likely that growth will be much weaker than what we saw, particularly through the 2010s. Now, if you look at the US, that economy has remained surprisingly resilient over the past year or so. However, in common with other markets, particularly advanced markets, per capita demand for red meat no longer appears to be growing there as the economy grows, although it has improved relative to where it fell to after the global financial crisis. So growth in the economy alone probably won't guarantee increased demand. However, unlike China, the US population is continuing to grow, albeit at a slower pace than in the past. And so I think that will help to underpin growth and demand for red meat in coming years. And then if we turn to the cyclical factors, looking ahead, the easing of cost of living pressures and the likelihood of somewhat lower interest rates should take some pressure off household finances in the US and Europe. We've already begun to see interest rate reductions in Europe, and we do think we'll see them in the US in the not too distant future. And that may flow through to increased demand for more expensive forms of protein, such as red meat, and potentially away from cheaper proteins, such as poultry.
Great. Thanks, Darren. So Paul, China is the big swing factor affecting beef and lamb consumption growth. What can we expect going forward?
Yeah, I mean, we like to call China the big swing factor, mainly because we think it's the real driver of export growth for sheep and beef. When you look at the breakdown of where we export to, most of New Zealand exports go to high-income countries, on an aggregate level basis, where per capita consumption is falling. Aggregate consumption in countries like the EU, the US, and the UK does, however, remain relatively constant given their populations have grown, albeit not by much. The situation in China is very different, and you can see that in the charts that I've got on the screen now. The chart on the left-hand side, which really refers to beef production and consumption and imports, you can see that the consumption of beef has grown really strongly, but the means to actually produce that has kind of been a little bit flatter. So that's opened up a gap for imports, and that has grown really strongly. The same is also true for lamb, I suppose to a little lesser extent, but the volumes are still quite large, and that's shown in the right-hand chart. I suppose that reflects the fact that that growth in consumption of both imports on both beef and lamb really reflects the fact that China is a middle-income country with a fast-growing middle class that has developed both demand for beef and lamb. That's helped to drive per capita consumption for both beef and lamb in New Zealand. Now, it's important that there's a couple of differences, of course. And when you look at the pace of consumption growth for beef, it's far stronger than it is for lamb. In fact, if you look at per capita consumption for lamb, it's actually growing, but at a slower rate. The same is not true for beef, mainly because it's seen as a premium product. I think looking forward, and Darren's referred to this briefly, I think China will continue to be a big growth market for New Zealand, at least for a while. However, the longer term, Chinese consumption of both beef and sheep lamb is set to grow, but the pace of that growth will slow over time. And that's really going to be driven, that's really because the expansion of the middle class will slow. We think customer preferences in China will start to align more closely with those of the in high income countries. And the other big factor, and I think Darren alluded to it, was population growth is forecast to turn negative in the not too distant future. With respect to other markets, we think that the US will continue to provide a stable market for New Zealand beef lean trimmings. It's still going to be there. As I mentioned before, New Zealand is a big exporter into that market. We also think that the recently concluded free trade agreements with both the EU and UK may become increasingly important, particularly for lamb, as demand from China starts to slow over a long period of time.
Right. So, Paul, given the trends in consumption and production, what is the outlook for beef and lamb export prices?
Yes, so as the charts on the screen show, we think that world prices, so we've got these in foreign currency denominated terms, are likely to drift higher in the short term and actually gain momentum over time. For beef in 2024, we think that beef prices will continue to be supported by sustained demand from the US, with still weak Chinese demand continue to provide an offset over the remainder of 2024. So not much in terms of beef, kind of moving sideways to slightly higher. And there are other factors that may impact especially on the supply side. We think that levels of competition among those big global suppliers is going to intensify, and that will limit the upside of the beef. And key here will be the return of Argentina to key export markets. I think in terms of 2025 for beef, we're a little bit more optimistic. We think we're going to see a partial recovery in Chinese consumer demand in 2025, and that will give it a bit of a boost. And added to that, of course, we think that the US will still be demanding its beef burgers, and that's good news for our farmers. In 2026, a continuance of those factors is likely to basically drive beef prices much higher. So we've got them rising at a much stronger clip in 2026. Really, that reflects the strength of the Chinese consumer as I said, in 2026. If we then swap over to the right-hand side, in the case of lamb, world prices in 2025 are likely to struggle. I should point out that in real terms, lamb prices are at close to record lows or decade lows. So there is significant upside there. In terms of world prices, we think that what are the factors underpinning the forecast? We still have this problem with a record supply of sheep meat coming from Australia, and of course still weak demand from China. So following on from it was about 600,000 tons, if I remember correctly, of sheep meat in 2023. Australia was expected to produce, I think it's around 621,000 tons in 2024, and that's quite a lot coming onto world markets. And they're selling that out into the same markets that New Zealand sells into. So that's kind of depressing the price somewhat. My understanding that 2024 production will be about 20% higher than the 10-year average. And that's really the fourth successive year of record production. And it's been able to do this because it's been able to build up its national stock, flock, for want of a better word, in recent years. I think it's currently sitting at about 76 million, but around about there, but that's only half of what it was in the 1980s, and but it has grown, and that's basically provided livestock for slaughter, and that's come on the market. So we think that additional Australian production will keep prices low. There are, however, other factors that might give it a boost, and I have talked a little bit about FDAs, which are allowing New Zealand sheep producers better access into the EU and UK markets, and more importantly, it's allowing them to basically sell product into those markets at competitive prices. And I am aware that there have been howls of anguish out of those markets from local producers that are facing competition from cheaper New Zealand lamb. That should help put a floor under lamb prices into 2024, however. In 2025, we see lamb prices starting to lift. The supply of Australian products is expected to slow as high slaughter rates in recent years reduces the flock size. So we should see flock size come down. We're expecting lamb production to fall to about 590,000 tonnes. So that's a bit of a decrease from 620, significantly low below previous year's records. And of course, as we mentioned for beef, we're likely to see a partial recovery in consumer demand from China, and that should also provide some price support. I would also say that the FDAs of both the EU and UK are likely to add further demand and add further price support. In 2026, we just see a continuance of those factors. So we see lamb prices continuing to rise, and you can have a look basically at the chart. We're kind of looking at basically moving back to about the 10-year average.
Okay, good news on the horizon. Thank you, Paul. Darren, if I can turn back to you, the path of the exchange rate will also impact farmer revenues. So what is the outlook there?
Well, the chart on screen shows the New Zealand dollar, US dollar exchange rate plotted against the inverse of the US dollar trade weighted exchange rate. And I think, as you can see there, the outlook for the New Zealand dollar is heavily influenced by the fortunes of the US dollar. Indeed, it's often the broad trends in the US dollar that is the prime driver of the big trends we see in the New Zealand dollar, with conditions in New Zealand really only impacting the New Zealand dollar at the margin. Now, in recent years, the US dollar has been in the ascendancy, and that's reflected the high US interest rates that we've seen, expansionary US fiscal policy, and an economy that, as I mentioned earlier, has been more resilient in the face of monetary tightening than what we've seen in many other major advanced economies. And as a result of that, the New Zealand dollar has traded near the bottom of the 60 to 80 cent range that we've seen over the past 20 years, latterly around the 61 cent mark. Now, here at Westpac, we think that the US Federal Reserve will likely begin to lower interest rates before year end, perhaps as soon as September, which is sooner than we are likely to see policy easing here in New Zealand. And as a result, we think the US dollar will likely weaken somewhat as capital begins to flow out of the US. Now, given that forecast of a weaker US dollar, that means the New Zealand dollar is likely to strengthen somewhat. We're forecasting a relatively modest appreciation of the New Zealand US dollar exchange rate to around about 65 cents by the end of next year. Now, if our forecast is correct, and I should say that forecasts of the exchange rate are fraught with particular difficulty, then over the next 12 to 18 months, a firmer New Zealand dollar will probably largely offset the benefits of the stronger world price returns that Paul mentioned earlier. However, we've got a very high current account deficit in New Zealand. This week, we've learned that it's still close to 7% of GDP. And I think that does lean against the likelihood of a more significant appreciation of the exchange rate. So a continued uptrend in global commodity prices that we predict, that should eventually begin to make its way into domestic returns. And it's also worth noting that the New Zealand dollar will likely remain more stable against the likes of the euro and the pound, which are also likely to rise against the US dollar as US interest rates come down. And as Japan slowly begins to lift its own interest rates, the New Zealand dollar, in fact, is likely to weaken somewhat against the yen.
Great, thanks, Darren. So, sticking with you, what about costs faced by farmers? Any good news there?
Well, as the chart on the screen shows, there is some good news, and that is that after peaking at an annual rate of over 15% in 2022, annual farm input cost inflation in the sheep and beef sector is now sitting at around 2.5%. So that's more in line with the long run average. Now, it's certainly true that prices continue to rise at a decent clip for some on-farm services, veterinary fees, animal breeding costs, and farmers, just like everybody else in the country, continue to bear the costs of higher insurance and local government fees. But prices have stabilised for the likes of feed, and of course we've seen some welcome reductions, including quite recently in the price of fertiliser. Even so, it's still the case that since the end of 2020, Expenses for your typical sheep and beef farmer have increased by more than 27%, and that's been kind of baked into the cost structure now. For example, fuel prices are up more than 60% over that period. And of course, another key cost for farmers, typically 10 to 15% of all costs, is debt servicing. And here, costs have increased more than 75% as interest rates have been lifted significantly by the Reserve Bank to combat the high inflation that we've had in New Zealand in recent years. Now, if we look ahead, we expect only moderate input cost inflation over the next 18 months or so something close to 2%. Now, geopolitical tensions do represent a source of modest upside risk to this forecast. I'm sure all of you have seen the increase in shipping costs over the past year, or certainly this year, due to the problems in the Middle East. Regarding debt servicing costs, as the Reserve Bank's chief economist noted just this week, the outlook for domestic monetary policy really does hinge on how quickly the very high rates of inflation in the services sector begin to moderate over the period ahead. Now, with the economy continuing to essentially flatline, as we saw in the GDP report yesterday, and the unemployment rate now on a clear upward trend, this should place downward pressure on inflation over the coming 12 months. And we do think the Reserve Bank will be in a position to begin gradually lowering the cash rate from early next year, which would obviously be good news for farmers and other businesses alike. Now, together with low interest rates offshore, as central banks elsewhere also continue to ease their policy, that should underpin a decline in wholesale interest rates, and with that, lending rates, and probably ahead of the actual decline in the central bank cash rates. But I should say that returning inflation all the way back to the midpoint of the 1 to 3% target band is not going to be easy. And so, we do think the farmers do need to be prepared for the likelihood that interest rates will settle higher than the very low rates that we've become accustomed to prior to the pandemic.
Okay. Thanks, Darren. So, Paul, putting this all together, what do you think this means for bottom line profitability in the red meat sector?
Yeah, well, I think there's no doubt, and I'm sure you know, and everybody that's watching this webinar knows that beef and lamb farmers are doing it tough. I was just looking at some beef and lamb numbers, beef and lamb New Zealand numbers. Inflation-adjusted profits for the current season are at a 15-year low. So that just basically says how tough things are for farmers. I'm trying to show that in this chart that's on the screen now. So the red line basically is red meat export prices in New Zealand dollar terms. So we've taken the prices that we had in a couple of slides back, and we've put them together, and we've applied the current New Zealand dollar exchange rate to it, and that's the kind of curve that we come out with. And you can see that basically the prices have come off quite considerably. And at the same time, we've seen the blue line really is an input cost line, and you can see that's the level of input costs. And then you can actually see that, the recent increase has been quite dramatic, and that reflects the farm input cost inflation that we have seen. It's obviously come off quite sharply now, and we're forecasting that to move sideways. Now, the gap between the two is kind of an indicator of profitability, of margins basically, and profitability. And you can see that certainly in the recent past we've seen a crimping of margins would probably not do it justice, but certainly a narrowing of margins. Unfortunately, I think going forward, we think that in 2024, at least for the remainder of 2024, we think that profitability is likely to remain under pressure. As mentioned earlier, sheep meat prices are likely to remain flat in 2024, weighed down by a weak demand out of China and additional supply out of Australia. The pace of input cost inflation may have slowed, it's true, but input cost structures are still up 28% or 27% or thereabouts compared to pre-COVID levels. The same applies, of course, to beef farmers, although not to the same extent. We expect prices to lift over 2024, mainly because of sustained demand out of the US. So when you look at that and you look at the gap between, we expect margins to remain under pressure. We also expect them to remain largely under pressure into 2025. World prices for sheep and meat and beef and for sheep meat and beef are set to rise off the back of a partial recovery in demand in China, as we indicated earlier. But we're also likely to see a strengthening in the New Zealand dollar, and that is likely to offset much of these gains. That said, we still think there might be a little bit better profitability, especially with input cost inflation basically falling. So there's not much gain there. So a little bit perhaps in 2025. In 2026, the picture is much better. You can see that tick up in red meat prices. Much of that's got to do with the increase that we talked about earlier for sheep meat and beef prices rising as consumer demand in China gathers momentum. There are, as we mentioned, other factors both on the demand side and supply side. We also expect the currency to remain relatively stable over that period, which also would give prices a bit of a boost. Longer term, and there is last point I would like to make. I think it is a truism that most sectors really, and it applies equally in the agricultural sector, that profitability will always move back to sustainable levels. It's important to note that when faced with global shocks and weak demand, such as we've seen in recent years, New Zealand's low-cost farmers are typically better placed than those overseas to weather the storm. Low levels of profitability that we've seen will eventually, I mean, the logic is that when we've got low levels of profitability, they do tend to squeeze out less efficient farmers in other countries, and that then removes supply from the market. When you've got that removed supply, you've got a better balance between supply and demand, and that tends to support prices, well, in this case, and it allows profitability to move back to more sustainable levels. So there is good news further out. Farmers, of course, know this, and they also know this adjustment also takes time to play out, and that may therefore be beyond 2025 before we see a significantly improved profitability. And as Darren has mentioned, by then lower interest rates will be also helping to boost profits for those with debt on their farm. So that's the outlook for profitability.
Great. Thanks, Paul. It's cyclical. We know that profitability comes back, and it'd be quite good just to extend that graph a couple more years to show that margin in there over the long term. Hey, just one last quick one before we go to Q&A. Darren, just are there any other issues out there that farmers should be paying attention to that may affect things in supply and demand?
Well, I think one thing that we're certainly paying attention to here, and it's not just with respect to farming, but with respect to the business environment that we might face, is geopolitical risk. We're clearly in a situation where there is greater than usual geopolitical risk, and because of that uncertainty overhanging the global economic outlook, and obviously we have the tensions in Europe and the Middle East, but we're also quite focused on the outcome of the impending US presidential election, which also poses a degree of risk, we think, to the medium-term outlook. Now, a new Trump presidency could further weaken the global trading environment. For example, Trump has pledged to introduce an across-the-board 10% tariff on imports to the US. Needless to say, such a tariff would be detrimental to New Zealand exporters, including farmers. In addition, a second Trump presidency clearly runs a risk of further fanning tensions in that US-China relationship, and that would be very difficult for New Zealand to navigate diplomatically. And we think it would also undermine confidence and also the prospects for global growth. So I think those risks do heighten the desirability of New Zealand looking to broaden and diversify its trading relationships, to the point we were discussing earlier, and to do this as far as possible. And if we can do that, that will reduce our exposure to global trouble spots as they do emerge. Okay,
great. Thanks, Darren. All right, turning to some Q&A. Got a few questions coming through here on Slido. Number one, we are seeing bird flu really starting to take off, even as close as Victoria and Oz this week. What's your view on the likely impacts on the red meat market? Who would like to take that one?
I'll have first go, and then I'll let Paul jump in. I mean, I think it's clearly bird flu is fatal to birds, poultry. I mean, my understanding is the research at the moment shows, because we're seeing quite a bit of this obviously in the US at the moment, is that for cattle, it's an illness that will affect cows for 2 to 3 weeks. While they have the illness, particularly a dairy cow will be about 20% less productive. It's not an issue for milk because milk is pasteurized, which removes the virus, but the cow does recover. So I don't think it's as big an issue for red meat as it would be for dairy because of that production loss. And it may even be positive to the extent that should there be an outbreak, a major outbreak in New Zealand that got into the poultry industry, then that would be very bad for poultry and could potentially substitute demand back towards red meat.
Okay. Thanks, Darren.
I would agree with that as well. I think the idea of, the one of the issues or one of the challenges facing the red meat sector is competition from poultry, white meat, and obviously anything that might affect the supply of issues around reputation. Bird flu affects the reputation of poultry, and that can only really be positive, I suppose, for red meat consumption. So yeah, I mean it's not obviously a good thing, but I would say it's marginally positive for red meat consumption.
Okay. All right, next one. What is the input cost inflation and with debt servicing costs removes, i.e., what is the farm working expenses inflation?
It would be a little less than that 2.5. I'm not sure if we can bring that chart up that I had earlier with the input costs by type. If we can get the right chart, if we move that on a little bit, the chart with input costs. Well, in any case, that's the one there. So you see that debt servicing, even in the last year, was still a greater than average contributor to costs. So 2.5%, including debt servicing, still up. I think it was about 6% over the past year. So take out debt servicing, which is about 10 to 15% of the aggregate cost. Probably more like 2 over the past year. But as you can see from that chart, it's quite a bit of variation across the different costs that farmers face.
Right. Thanks, Darren. Yeah, I mean the only thing I would add there is the fact that it is the second largest component of farm input expenses, behind I think fertilizer. So yeah, I mean it is still a significant contributor to inflation.
Okay. Thanks, guys. The New Zealand export market slide. Sheep specific. Can we extract our lower from higher value cuts / age classes and determine what markets these products are being sent to?
Excellent question. I mean, obviously the data that we see from Statistics New Zealand tends to be aggregated. I'm pretty sure we could get that data from Beef and Lamb New Zealand. I'm pretty sure they would have some insight into that.
And if we could add that as a supplementary slide when we lodge this on our internet site.
Absolutely. Yeah.
Okay. Thanks, Darren. What volume of our exports are subject to tariffs or quotas? Beef and a beef versus sheep meat split.
Yeah, I mean that's quite an interesting question as well. I mean we certainly had significant quotas when we were selling into the EU and the UK. But having said that, we didn't actually take up those quotas. I think we used about 50% because we were piling sheep and meat into or selling sheep meat into China. Now, of course, we've got the FDAs, and they have kind of a ratchet. They have a limit a quota that kind of ratchets up over time. So that's likely to be, but it's unlikely to be a major constraint to basically export growth into those markets. I did also thought it was quite interesting that a number of these countries are squealing a little bit, including the US, which is a relatively small market, but is a growing market for our lamb exports. They were squealing about the fact that we were coming into that market and basically taking market share away from local producers in that country. And they've asked basically their authorities to slap restrictions on us. So we'll have to see how that goes.
Yeah, thanks. All right, guys, that's our allotted time. Many thanks to Darren and Paul for their insights, and thanks to everybody that has tuned in. You'll see there is a survey poll on the right of your webinar. If you'd like to leave a rating or feedback, we would love to hear from you. This is also an opportunity to share any thoughts or topics you'd like us to cover in the future. We'll be posting this video up on our Smarts channel if you want to watch it again, or you can share with friends and colleagues. So thanks everyone for tuning in, and enjoy the rest of your day. Thank you very much.